everyone, and welcome back to the Private Practice Growth Club YouTube channel. If you're new here, I'm Tasneem Abrahams, I'm the founder, and on this channel, we share tips, tools, and tutorials for health professionals starting and growing practices in South Africa. Today, I have as my guest George from Growth Accounting Services. He's a qualified chartered accountant and a registered tax practitioner, and he kickstarted his career by completing his articles at KPMG, specializing in tax structuring and planning, and he quickly became a prominent figure in the financial world. In 2016, his exceptional contributions were recognized when he was nominated as a finalist in SAICA's prestigious Top 35 Under 35. So currently, he's the co-founder and CEO of Growth Accounting Services, and in this business, he dedicates his expertise to advising small and medium-sized enterprises on growth and tax strategies. Beyond his professional pursuits, his passion lies in empowering entrepreneurs and creating opportunities for youth, and his commitment to fostering success in both business and communities has positioned him as a dynamic leader and speaker in the finance and entrepreneurship arenas. And this is why it was a no-brainer for me to have him on, because as you know, I'm also very passionate about entrepreneurship and empowering business owners. So welcome, George, and thank you so much for joining us today.
Tasneem, it's fantastic to be here. Thank you for that phenomenal introduction.
So one of the questions that comes up on the various platforms very often, or sometimes not a direct question, but comments or conversations that come up, is always around business structuring and business entities. I have this checklist that I offer to my audience for those who are thinking of starting or have just started on, what are the things you need before you see your first client. And one of the first things I have in that checklist is you need to decide what your business entity is, because that affects all your decisions in terms of how you start your practice. But the question is very difficult for somebody who is not in the business sphere. Many people even ask, oh, how do I register my sole prop? Like they think they need to register it. So it's complete zero knowledge in this area. So I thought it would be great if we could start with that as the basics of what are the different types of business structures that you get?
Yeah. So I mean, there's a couple of business structures there, but I suppose the one for your audience and the medical industry is really just around a sole proprietorship, partnership, or an incorporated. So it's basically those are the three options available to medical practitioners when they go into private practice and when they're deciding on how to trade. Each has their pros and cons, and I'm sure we're going to go into in a lot more detail shortly. But the main business structures that we most often see is either a sole proprietor or an incorporated.
So what is the difference essentially between sole prop, partnership, and incorporated?
Yeah. So sole prop is, think of it as you trading as yourself. So you're trading almost in your personal capacity. So you're a sole proprietor. I'm myself, George, am running a medical practice, and I don't need to register anything. I don't need to incorporate or form a company. I just start trading, and when I eventually compile my tax returns, I complete those tax returns as a business segment of my personal tax return. Whereas an incorporated, on the other hand, is a juristic person. It's an entity that we do an application to incorporate, or we form with the CIPC. And then once that entity is formed, it takes on a life of its own. And so all the taxes, it'll get a tax number, it'll get a registration number, it'll get a VAT and PAYE number. It's its own legal persona. And all the trading, all the services rendered, all the expenses form part of that incorporated, and we complete taxes as part of that incorporated. But one of the things that it's, I suppose, at the beginning of this conversation, very important to note is that registered doctors with the HPCSA are regulated in order to trade either as a sole proprietor or an incorporated, purely because they need to maintain personal liability. But the HPCSA doesn't want medical practitioners to be able to hide behind some type of corporate structure in the event of some type of a claim. They want medical practitioners to be completely accountable for their actions and be personally liable should something go wrong. And that's why we're trading as an incorporated. So I'll give you a simple example. Most companies that would go register a company would register as a PTY, which is a proprietary limited. And essentially what that limited part stands for is limited liability. So all the liabilities of this company are limited to this company. They don't extend to the shareholders or the directors of this company. So if there's a debt, if there's a claim, if something goes wrong in the company, it's limited to the company, and my creditors can't come after me personally in my personal capacity. Whereas an incorporated has personal liability and the sole proprietor has personal liability. So if there's an event that occurs, there's a complete look-through principle, and the company, as well as you in your personal capacity, will be liable for any of those debts or claims against the incorporated company. So personal liability is a really, really big concept in the medical industry.
Yeah, so thank you for explaining that, because I think I'd like to always take a step back to also, it makes complete sense, but there are some terminologies in there for let's say you get a practitioner who's fresh out of community service, they've done community service, they've maybe worked a few places, now they want to start a practice, they have zero experience with business world. So even just the term liabilities is like, well, what is liabilities? Like, what does that actually mean? So can you just explain, what do you mean by personal liability? Can you give examples of a situation where somebody is held personally liable and where there's limited liability?
So personal liability would be an example of I perform a procedure on a patient, and the procedure goes wrong, and that patient comes and sues me for damages. Whether I'm trading as a sole proprietor or as an incorporated, I am personally liable for that claim that comes about. So say that the court orders me to pay 5 million rand in damages to this patient. If my company doesn't have the funds available to pay this, I, out of my personal capacity, have to make that payment. And that's personal liability. It's the same with debts. So we see it in the dental community. There's quite a big upfront cost to set up a dental practice. You have to buy all the equipment and obviously kit out your rooms. And in order to afford those costs, you take out a loan. Now, typically in a PTY, often that loan is limited to that company. So if I can't afford to pay that loan or something goes wrong, they can't come claim my personal assets from me purely because it's a limited liability company. But in an incorporated, I and the company are jointly and severally liable for any debts. And if the banks come and put a claim against me because I defaulted, they can claim against the company as well as directly against me in my personal capacity.
Okay, yeah. So then that begs the question then that people would say, well, isn't the whole point of registering a company to have it as a separate entity? What then would be the benefit of registering a separate entity to yourself if you don't have that protection?
Yeah, great question. And really the answer lies with the tax optimization and wealth and estate planning. So when it comes to medical practitioners, you're always going to be personally liable. You can't run away from your obligation, and you have to be accountable for your actions, right? But why do we come to the decision whether to incorporate a company or not? It comes down to how can we be most tax efficient in our operations? And as we know, the medical industry, because there's generally quite high levels of earnings and low levels of deductible expenses, the tax exposure is quite high. So where we can optimize on tax and really put structures together that are quite tax efficient, we need to consider that. Secondly, we need to also build wealth in a business structure that when it comes time to pass that wealth onto our beneficiaries, because, I mean, ultimately, Tasneem, we're all going to die at some point. And we want to be able to transfer all of our wealth and hard-earned money to the people we love and our beneficiaries without incurring what they call the death tax, and that's estate duty. And that's 20% of the value of your entire estate goes to paying tax if you haven't put the right business structures in place early on.
Okay, so the way you described it, from what I understand then, is that this decision about which business entity you choose isn't a decision around protection of liability necessarily, but it's actually not it's not a decision based on your current need, but rather a future need. So it's almost like you have to think, what is it that I'm working towards, or what is it that I'm trying to protect towards, kind of, rather than...
Exactly. It's a bit of a journey. So when you're starting out, it might make more sense for you to trade as a sole proprietor because the tax that you pay is going to be less. But as you start growing in private and your earnings start becoming more, you want to optimize on your tax, so save as much as you can. And then as you start accumulating wealth over your career, you want to start putting that wealth in a structure that A, is protected from liabilities. Again, you're personally liable for anything that goes wrong. And B, is in a structure that can be passed on to your beneficiaries without incurring massive tax consequences. It's really just from a business perspective, tax optimization, protection, and estate planning. From a protection side, unfortunately, you don't get much protection in an incorporated.
Well, which is, I suppose, where malpractice insurance and all of that comes in play, where you have to then make sure that you are covered, in terms of your liability, the insurance. So, but I'm glad you brought up that you mentioned, that obviously when you're starting out, it isn't tax efficient to be registered because of the tax bracket. So does that mean that it is advisable when you're starting out and you have like nothing, you have no clients, you don't even know if you're going to get clients? Are you then suggesting that it is better to start off as a sole prop? And then if that is the case, how easy is it to switch from a sole prop to a company down the line?
So registering a company takes about let's say 3 to 5 days. So it's a really easy process. And while your earnings is, quite low, within that tax bracket, that it doesn't make sense to register a company that you're still working as a sole prop, to transfer your business into the incorporated is really, really simple. It's quite easy. I mean, to touch on the tax brackets, and, for some of the listeners or viewers who don't know, individuals are taxed on a progressive tax rate. So the more you earn, the higher the percentage tax you pay. And that tax range is between 18% all the way up to 45%. So to your point, if you're earning at the 18% tax bracket, it's really, really tax efficient. Continue working as a sole prop. There's less regulatory requirements for you. Setting up in terms of the administration is there's limited to no administration on trading as a sole proprietor. And the initial setup cost is zero because I'm trading in my personal capacity. In a company or you're incorporated, they tax at a flat rate of 27%. So what we generally look at is to say, well, you shouldn't really be paying more than 27% tax. So, and as soon as you start paying more than 27% tax, we've got to start considering moving you to an entity that again brings down your tax rate to that 27%. And that's when we incorporate the company for you.
So the way I understand it now is that because as a sole prop, you are the business, are you then taxed on any revenue that gets paid to you?
Yes, correct. So any revenue that's earned that gets paid to you, you are taxed on.
So you mentioned a word earlier, which is tax-deductible expense. Can you explain that to me, and how does that then impact your tax as a sole prop, for example?
So just a concept around tax, right? Whether you're a sole prop or whether you're an incorporated, all your income is going to be taxed, and generally the expenses are going to be tax deductible. But on the tax deductible expenses, it needs to be a business expense that's in the production of income. So it has to be a valid business expense that generally SARS allows you as a deduction. So if there's an expense that I've incurred to produce income, like the rule of thumb is you're probably going to get a tax deduction on that. If it's an expense that's more for private or personal use, a trip to Cape Town or a family holiday, you won't be able to get a tax deduction for that. So the sole proprietor, because you're doing the taxes in your own personal name, it's really important for you to be able to separate out what's personal and what's business. And we generally tell our clients, register another bank account that all your income's going in and that all your business expenses are going out. And when you want to pay yourself, pay yourself from your one bank account into your personal spending bank account. That way, it makes it really easy when we get to tax season or the end of the financial year to compile your sets of accounts and know how much tax we need to declare to SARS. So how much income you earned, less how much expenses we're going to deduct. From the company, it's obviously, a company is a separate legal entity. It's easier to do that because all your business expenses should typically be confined to the company. If there's personal expenses, it goes to a loan account, and we sort out the loan accounts at the end of the year. But from how the tax works, it works exactly the same across both the sole prop and the incorporated.
Okay, so is it true that then salaries or wages are not a tax deductible expense?
No, that's salaries and wages is definitely a tax deductible expense. So what we often find is, if you're incorporated and you're paying yourself a salary, that's tax deductible for the incorporated. Okay. But for you as the employee or the recipient of the salary, you would need to declare tax on that. And typically, if it's a salary, a bona fide salary payment, we would have paid PAYE over on your behalf when we've made that payment to you. So we would have withheld pay as you earn. We would have paid you the difference, and the pay as you earn would have been paid to SARS, including your UIF and SDL.
Yeah.
Whereas if you're trading as a sole prop, you can't pay yourself a salary. Like it's, like you're just taking a drawing. But ultimately, as a sole proprietor, what we try to calculate is what is your total profit? What is your total taxable income? So my income less any deductible expenses gives me my taxable income. What is that amount that you need to pay tax on? And that's the calculation that we do.
Okay. That is such an important thing to distinguish, I think, because I think that's where a lot of confusion gets in with practice owners is that, well, if I'm paying myself a salary, like as a sole prop, then surely that's, but like you say, because it's all part of the pot, it's not the tax deductible expense, whereas in a company. So I'm sure that's where a lot of calculations from you as a tax consultant would come in to say, like, this is how much you can actually deduct from your expenses and what you'll be left with, which puts you in this bracket, versus this is how much you can deduct as a company, which puts you in this bracket. So another thing that then comes into play is if you are then registered as a company and you can take your salaries as a tax deductible expense, but now if you pay yourself a salary in your individual capacity, then you become that you need to pay tax, which, like you're saying, it's pay as you earn, but then obviously you have to take that into account. So how do you advise your clients, to look at it holistically, both from saving tax for your practice, but also making sure that you in your personal capacity are also tax efficient? When you combine the two. Do you understand what I'm trying to?
No, I'm having a chuckle because it's a fantastic question. You obviously know what you're talking about because it's quite a leading question as well. It's exactly that. You have to view the person and the company almost together and find the way that's going to be most tax efficient. So at no point do we want to pay a salary over to you where you're going to be paying more than 27% tax, right? So we want to pay you a salary that allows you to pay off your living expenses, your bond, school fees for your children. We want to get you to a salary that resolves all your personal needs, but predominantly we want to retain business profits within the business, and on those business profits we are taxed at 27%. And then there's a whole other structure that goes up with dividend tax. There is a thing, I don't know if you've heard of dividend tax. Eventually, when we distribute a dividend, there's going to be a 20% tax on that dividend that's paid to you. But the thing with the dividend tax is it can be deferred. So instead of paying a 45% tax now, we pay a 27% tax now, and we only pay the tax on dividends as and when we declare that dividend. So if you need more money, we pay a dividend and then get it into, we pay a dividend to you, you get more money, and we pay that dividend tax over. But the reality is we can defer that tax event, which is the one thing. And the second thing is there is a little bit of an arbitrage opportunity because the highest marginal tax rate is 45%, and the effective rate of company tax and dividend tax is, I think it's 41.6%. So you got roughly about a 3% tax saving at the end of the day.
That is so fascinating. Tell me then, what happens if, you mentioned it earlier, is that you also get a partnership. My understanding is a partnership is a sole prop, but with more people.
Together of like-minded individuals that want to operate together, and they say, cool, instead of all of us incurring separate rent and separate water and lights and separate secretarial fees and accounting fees, let's all pool our funds together, pay one group of costs, and at the end of the day, whatever profits are left over, we split it in terms of the partnership percentage. But then when we're filing the tax return, we're still filing the tax return as a sole prop, in your personal capacity.
So how does that complicate things when you are looking at when it's time to actually incorporate, when you have more people to consider? Are there any specific considerations people need to take?
We've actually found that the incorporated works better than the partnership. It's got shares, right? So if I want to bring in someone into the company, if I want to go into partnership with them, I can register and incorporate it, and I get 50% of the shares and Tasneem, you can get 50% of the shares. There are a lot of guidelines that the HPCSA has implemented around this, that specialities have to be in partnership together. If I'm an ophthalmologist, I can't go into partnership with a radiologist. It needs to be similar.
Actually recently changed that rule. They had to say November last year, they changed that rule. They now permit any profession that is registered under the Act. So even not HPCSA, it can be HPC. So I, as an OT, can now go into practice with the nurse. It's now permitted. You still can't employ cross-discipline, but you can go into partnerships or incorporate with, as long as it's somebody who's regulated by the National Health Act.
Okay, so they're going to be kind of pay their membership fees and be regulated.
Yeah.
Well, then that's fantastic, but still I suppose the premise stays the same. It's easier to transfer shares than get in and out of a partnership. And then ultimately, when I'm declaring your taxes, I'm still declaring the taxes as a sole prop, where there's going to be a 45% potential tax liability as opposed to the 27%. And I do find that the incorporated do give you a little bit more flexibility. When we're registering for VAT, I register for VAT as the incorporated. If I have to register a partnership for VAT, I've got to register the partnership under one of the partner's personal names. So then you as the partner, take on all of that liability. If we're going for funding, it's easier to submit a set of incorporated or financial statements to the lenders or funders. The partnership slightly more complex. I haven't personally seen many partnerships of late. I think it might be more of a traditional formation or way of doing business. Currently, we're seeing most of it either the sole props or guys physically incorporating. And when they want to sell out, it's quite a simple process. It's a quick valuation. Here's my shares, someone else buys, and they're out.
Yeah. So I'm glad you brought that back, because that is obviously a huge pain point for practitioners who reach that point. What does one need to consider? So, and I think a lot of practitioners, when they start the practice, they don't even think of that because they think like R1 million is like way off into the, like, I don't even know if I'll get there, but it's obviously something they have to consider, right? So, how does VAT then, maybe first explain exactly what VAT is, like how does it work from a practice administration billing type point of view, like the money side of it, and then how does that affect your decision about whether you are a sole prop or a penny?
Yeah. Okay, so VAT is value-added tax. It's a tax on consumers. So essentially, what's happening is we have our price for our service, and the price for our service is generally our price plus VAT. When we receive the money from the patient, or in most cases the medical aid, that money or the funds that we receive includes VAT at 15%, which is the current VAT rate. We need to, and that's called output VAT. So if I'm making a sale, sales are going out of my business, and it's called output VAT. And if you are VAT registered, you're allowed to claim input VAT. So if I make a purchase, goods and services are coming into my business, I'm allowed to claim input VAT to that. Typically with medical practitioners and the practices, there's a big VAT exposure because your service line is quite high and your VAT deductible expenses are generally quite low. You can't deduct salaries, is not VATable, so you can't deduct VAT on that. Interest and finance costs not VATable, so you can't deduct VAT on that. It's quite limited to probably your practice management, whoever's helping you with your billing, your accounting fees, possibly rental, a couple of other charges. But predominantly your VAT exposure is quite big. Now, I always explain VAT in terms of that's not your money. We as businesses or business owners, we act as a conduit, as a collection agent on SARS's behalf. So the patient or the medical aid will pay the VAT to us, and we need to then pay that VAT over to SARS. It's never our money, and it shouldn't be viewed as our money. And I think many people run into cash flow problems because, they haven't put the money aside, and then they've got a 250,000 Rand VAT liability every 2 months, and they just don't have the funds available to pay it. So the discipline around VAT is really, really important. And there's not much flexibility around VAT planning. I mean, VAT is VAT. I pay over what I receive, and I can claim some of the VAT on my actual VATable deductions, but the rest needs to go over to SARS. So It's one that you need to be aware of. You need to make peace with it. You need to understand why it exists. It's a tax on consumers. So technically, us as the practice owners are not paying the VAT. The person who paid the VAT was the patient.
Yeah.
And we're just collecting it on SARS's behalf to pay it over.
So it's kind of like, if my son's birthday, somebody gives him cash for his birthday and they give it to me in an envelope. So I'm holding on to it and then I'm supposed to give it to him. But now I go to the shop and I need like money for bread. So then I'm like, okay, I'll quickly like buy the bread. And then he asks, Mommy, can I have my birthday money? And I'm like, I don't have it. It's kind of like how I imagine the VAT to be, the customer's giving you this 15% and you're supposed to like keep it until the government needs it and then you spend it and then now it's gone and you owe them it.
It's a great example, and it's exactly like that. The second part of your question was around the difference between VAT as a sole prop or as an incorporated. There's no difference. It's treated exactly the same. When you turn over more than R1 million in revenue, you need to register for VAT. And it's not when you turn over more than R1 million. It's the regulation or the rule actually says if in any future 12-month period you foresee that your revenue will be more than 12 million, more than 1 million, then you have to register. So a lot of people get the registration timing wrong because they only do it when they've reached $1 million. Technically, or in technical terms, it's when you foresee that you're going to reach $1 million within a 12-month period, you need to register. But both requirements are exactly the same. For sole prop, you need to register. Incorporated, you need to register. It doesn't change between the two.
Okay. So I had an interesting question in the Facebook group recently. I can't remember the exact wording, but this person was saying that they are going to be reaching the VAT, the threshold very soon and will need to register for that. And they wanted to know if I don't know if somebody advised them that if they are a sole prop and that if they now register as an Inc, it will reset. And then they wanted to know, should they do that or should they split the business? That sounded a bit dodgy to me. Should they split the business so that they can keep both under the thresholds where they don't have to register for that? Something along those lines, but I think you understand what they're trying to ask. So
yes.
Can you maybe comment on that, on what that person's asking?
Yeah. So what they are ideally trying to do is to say, I need to register for VAT because I've reached the R1 million threshold. What are my options? Okay, let me register an incorporated so that when my incorporated's registered, I start from fresh, right? So now my incorporated hasn't had any revenue, so I can possibly get another couple of months out of my incorporated without needing to register. But again, like I just previously said, the VAT registration rules are technically when you foresee that your business, so on the date of incorporation, your business.
You already, because it's not like you got rid of your clients and you
No. So in theory, you should be your incorporated on the date of registration, or as soon as you've got 50,000 rand worth of invoices, so that you can do a voluntary registration. Now, I do know, like many people, that do push it, a couple of months on, and they end up saving a little bit of money on that. It's technically not 100% right. The enforcement from the SARS side, I think that's difficult for SARS to enforce it. And so they take a chance. They're skating in kind of the gray area, but suppose each to their own. The guys that go and split out businesses. So I'm a sole prop and now I'm going to have one practice here and one practice there. That's called disaggregation. And if SARS catches you doing disaggregation, what they'll say is, no, technically you got a practice that does R1 million here and R1 million here, that's neither of them are VAT registered. We're going to aggregate them, and on that R2 million worth of revenue, we're going to charge you VAT on that. So they're gonna coin you 300,000 rands worth of VAT, and they can go back and do it. It's difficult for healthcare practitioners to do it because you've got one HPCSA number, right? You can have multiple practice numbers, but then you've got one registration number. I don't know. It's not really a practice that I would advise on doing. Yeah, I think it's risky. SARS's engagement with taxpayers is really, really high. And if they see that as a sole proprietor, you're recording for the same business type two different revenues, that's above the VAT threshold, there's certainly going to be a lot of questions that need to be answered.
Yeah.
You potentially won't be able to answer them correctly.
Yeah. And I suppose because you have to also remember, it's going back to that thing of looking at something holistically, that at the end of the day, you in your personal capacity could then get flagged for an audit because they're also noticing on your side. So somehow everything will be linked to your ID number. So, I suppose it's the opportunity cost. You want to take the chance and save some bucks and then take the risk that you might have the headache of having to deal with SARS and nobody wants to deal with SARS. So, I mean, my advice basically to that person's comment was to seek advice from a licensed professional who can give you tax and business structuring advice, because that isn't something you should be asking a bunch of colleagues on our Facebook group.
So it's an interesting. I actually did a post on this the other day. Around, I called it bad tax practitioners, right? So you have to remember that you're liable in your personal capacity to SARS. You are the taxpayer, Tasneem. It's you. If anything goes wrong, if I file a tax return on your behalf and I fudge those numbers and I make you pay no tax, and you say, George, you're the best tax practitioner in the world because, I never have to pay tax with you.
Yeah.
If I'm doing dodgy stuff, and SARS picks up on this. SARS, there's some liability on my side. Yes, I'll get cuffed by SICA and SIPA and all the professional bodies, and I'll probably lose my license, and I've got to answer to SARS and all this other stuff. But you're liable. You're the taxpayer. You're liable for that tax. And SARS isn't going to come after me. They're going to come after you for all those back taxes that need to be paid. So as much as you get tax practitioners that seem to be reducing the liability for many taxpayers, if you're not doing it in a risk-free, well-structured, optimized way, you're creating risk. As it stands, medical practitioners, especially the specialists, are at the top of SARS's high net worth radar and agenda because they have taken advantage of the system quite regularly in the past. And SARS knows that, following these people and making sure they're compliant is a good source of income for them. Yeah, I'd tread very cautiously when it comes to these gray structures.
Yeah. No, absolutely. I agree with you. It's better. But on that note, I would like to I think it's important to emphasize then the importance of having a knowledgeable, trustworthy source of consultation, right? So, because we don't know what we're talking about, you need to have somebody who can really sit down and somebody that you can be open with about your books and stuff and not be shy to say, well, actually, I've taken so much out for my personal use, whatever. So maybe can you just explain what exactly is the role of an accountant in managing your tax efficiency and, your finances in your private practice?
So it comes down to the size of the practice. So your practice is quite small and you're running it as a sole proprietor. When you're not VAT registered, it's quite easy because your compliance requirements are fairly low. You have to file 2 provisional tax returns a year and you have to do a final income tax return. As soon as you become VAT registered, then you have to start keeping regular sets of accounts, and you also have to start keeping all the supporting documentation for your VAT income and your VAT deductible expenses. So it's filed every 2 months. So generally it's bi-monthly. The role of your accountant is to compile your sets of accounts to tell you, Tasneem, this is how much money your practice is making. This is what's going on in your practice. This is where your spending's happening. Look how much travel you spent last month going from patient to patient or traveling between hospitals. This is how much income you made from this hospital, but here's the expenses related to that hospital. I'm not sure it's worth you still operating out of those rooms. Maybe we must close it down and focus our attention here where you're making most of your revenue. An accountant is there to provide you with data. And without data, without information, you can't make strategic decisions in your business. The second part is to optimize on your tax. Now, when you're operating or performing a procedure on a client, there's best practice. They teach it to you, and every now and then the best practice, so there's iterations to it and some changes so that it gets better. And it's the same with how we set up tax structurings and tax optimization. It's start to finish. There's a formula to do it, and there's best practice that's out there. And what we've done is we've consulted with some of the top medical malpractice attorneys in the country, tax professionals, retired specialists, to engage with them and ask them, how have you set up your structures, and what do you wish you knew then that you know now, and really put a structure together that helps medical practitioners reduce their tax, get the right information so that they make better decisions in their business, plan for their estate and obviously protect their wealth from any types of claims. And just one more note, when it comes to the tax discussion, as solid corporate citizens, we need to pay tax, right? The company, the country, that can't function without our tax contributions. And I always find that if you're smart with your tax, the professionals that plan their taxes well, but don't focus on how much tax can I hide and save, rather spend that energy focusing on how can I grow my practice? How can I do more to generate revenue? How can I bring in, different service offerings and different lines, and where can I invest my money so that I get a better return? The individuals that have this positive growth focus on their businesses and their practice tend to do way better than the guys that are that don't want to pay tax. If you're paying tax, you're making money. If you're paying tax, you're doing well. There's something going well in your business. How do we focus our attention on growing what's going good, cutting what's going bad, so that we can pay our tax, but ultimately you end up with way more wealth.
I love that. It's basically saying people should be solution focused rather than focus on the negative, because it's that thing of you attract what you focus on. So if you're focusing on the negative and avoiding and whatever, you're actually like preventing yourself from moving forward. Whereas if you are thinking positive and growth and cultivating wealth and all of that stuff, then you're not going to be afraid to earn more and pay your dues, because at the end of the day that we benefit from the tax that we pay ourselves.
Yeah.
So I really love that. But, something you mentioned is that, of course, that accountant then isn't just somebody who produces, sends you a profit and loss statement. They actually need to give you some strategic advice, which means that then you need to have more of a relationship with your accountant. But it seems like a lot of people just, have an accountant just do the things and they never meet the person, they never speak to the person. How important is it for you to almost know your accountant and have a relationship and actually consult with the person?
That's critical. It's absolutely critical. So when I view the accounting industry, there's so many changes happening at the moment. There's a lot of AI and automation coming into the industry. And the role of an accountant in the past was, let me grab all the slips, let me capture these slips into Pastel, or, let me give you a profit and loss, and okay, please pay your taxes and pay my fees. A lot of that process is now being digitized and automated. And we have to now revisit, what is our role to our clients? And our role is really around being a trusted advisor to clients. And what we need to say is, now that I don't have to spend time capturing invoices, let me spend the time focusing on what the data is saying in your business. How do I get insights out of this information so that I can report it onto you and say, Tasneem, consider this, look at that, don't forget about this, and what happened here? Why did our revenue spike 40% last month? Did we do something different, or was it just a lucky month? So it's really being that partner to business and creating awareness, because it's through awareness that we can drive change. And often we don't, I wouldn't say give advice, but through the awareness, exactly what you need to do tomorrow to create generate more revenue and grow your business. So those are the one things. And then the other is, I think because healthcare practitioners sell hours, and any person who sells hours don't have time. So they're always making money, but they don't have time to look after their money. And there's a lot of people that take advantage of that situation, whether it be insurance brokers and the life insurance that the guys are looking for, investments, what type of commissions are they paying? So what we seek to do is really serve our clients with a benchmark and say, listen, your insurance looks really high. I'm not too sure, but maybe consider getting one or two other quotes. Or let's get a revision of your professional indemnity insurance. I know it's sitting over here, and maybe it's high because you were, in your first couple of years of operating. Now that you established a name and more of a reputation, we could possibly bring that amount down. And you need someone to be able to present that information to you so that you can be aware of it and that you can kind of initiate the change.
That's such great advice. But, I'm just thinking when you're speaking about the data and that, when you have an accountant and you have processes in place, but let's just paint the picture of somebody who's just started, they're a sole prop, and they don't yet have an accountant, but eventually they're going to get there, right? But there's this backlog of data that they haven't been, because in order to
Yeah.
make decisions on data, you actually need to process that data.
Yeah.
So what advice would you give those who are sole props, who are starting out, in terms of just making sure that you have some sort of way of recording the right data? What data should they be recording? What is the best, simplest way for someone just starting out to record, so that when they get to that point where they say, okay, I need an accountant, that it's easy to, like, hand over or transition to that. So
Perfect. I actually just had a meeting this morning with a similar case. So doctor, she's she's a specialist, and she's kind of like at that point now where she's been in private for 9 months. But she did it right. So our life is going to be so easy. As the sole prop, all I really have to do for you is your 2 provisional tax returns and your year-end tax return. She's not VAT registered, so she's below the R1 million threshold. So it kind of makes life quite easy. But she's got a separate bank account. So I just take that bank account, her bank statements, and I can allocate all the income is revenue and all the expenses, kind of go through the expenses just to make sure that they are business expenses, and then claim whatever deductions, and then we can get to a taxable income number. So long as they've done that, it makes life really easy. And then they just need to keep their tax invoices or tax expenses. A lot of people take pictures of them and upload them to OneDrive or Google Drive, or there's a couple of other apps out there that like HubDoc or Receipt Bank is one of them, where I think you pay a small monthly subscription. You keep taking pictures of your tax invoices, and then it stores it in the cloud, so that if SARS ever queries the tax returns a bit, we've got the supporting evidence to support your deductions.
Okay, so I mean, then basically you mainly just need a record of the bank statements, which means then it would be advisable when you're starting out to always download those statements when you receive them, because obviously if you've got like 2 years, then when you go to your bank, online banking, you're gonna have to pay for all the statements when they send it to you for free. And I know that's a mistake. A lot of people, even I'm like, I see the email and then I just archive it. It's like, you should actually like download all your statements and keep it somewhere, so that one day when you do need it, you could just send the person the whole like bang lot and they can.
Absolutely. And then just one step further, if you can download those bank statements in like an Excel or a CSV version, rather than a PDF, it just makes it so much easier, because when we get those PDF statements, we have to convert it into Excel. Sometimes it misses out on a comma or a zero, and then you've got to find the difference. So it's a bit of a schlep. So get those bank statements in Excel format, that would be ideal.
And that's one of the advantages of opening a business bank account, because they always then send you a CSV version, whereas with a personal bank account, they don't.
Yes.
To specifically request it. Now I think that's such a simple, easy, doesn't take any time to know from the start. Okay, just let me keep my CSV bank statement somewhere, so that one. And I think the key thing is also like, when you're starting out, there's a lot of self-doubt and all of that. But if you almost like manifestation isn't a woo kind of like, I wish it and it'll be. It is about saying that I know I'm going to be successful. I know I'm going to get to this point where I'm going to eventually need to register for that. I'm taking the steps to prepare for that. It means that it shifts your mindset to almost be more growth focused, and therefore invite more growth into your life. It's not because it's magic.
Absolutely. Elon Musk, I mean, he's a phenomenal individual, but he had this saying that if you gave me a day to clean my room, it'll take me a day. If you gave me 15 minutes to clean my room, it'll take me 15 minutes. So it's really around the goals that you're setting for yourself. So what are those goals? So if you want to scale your medical practice faster, you can. Like you can scale things faster. Like if you said, how do I 10x this? And that's your thinking, that's your goal. Your thinking of how you're going to do it is going to completely change. Getting 1 patient or 2 patients. If I said, hold on, I want 50 patients, like how would I go about doing it? There's a way. You've just got to think differently about it.
So there are lots of questions still around that, because obviously there's a reason why health practitioners particularly struggle with it. But I think that's a whole topic on its own. So I think we should leave that for another time. But thank you so much for your insight. I think it's really important for people to have this knowledge, like right from the beginning. Tell me a little bit about, because you kind of alluded to some of your clients and the different types of service. And can you just give an overview of what the different services you offer for different types of people at different stages of the business?
Okay. So I mean, we work with the healthcare practitioners literally from the day they start out. Actually, like while they're still doing their ComServe or in government, all the way through to, you know, when they're running really big and successful practices. And it's a bit of a journey. We must run our own race. We've got a product for each stage of that journey, and we call it our Wealth Shield product. And Wealth Shield is really just around how do we protect your wealth that you're going to accumulate over your career from any claims, and how do we make sure that we optimize it so we protect it from you know, excessive tax and SARS as well. So we work with the healthcare practitioners from literally the start to the finish. It's of course, it sounds complicated, but it really isn't. And once we sit down with the doctors and the medical practice owners and explain to them exactly what we're going to do, it's quite an easy to run and administer process. And yeah, I think we look after their taxes, provide them with, well, we do their accounting, so we provide them with monthly insights and management accounts. We help them with their payroll, and then also when it comes to advisory work, just ensure that that their practices are running, you know, according to best practice methodologies.
I'm so glad you mentioned that word payroll. That is another one that is in a whole other like session on its own. So we can definitely, you know, if you're up for it, we definitely need to schedule something to talk about that, and we need to talk about payroll. And you also mentioned, you know, you want to maybe sell your practice one day, or you know, how do you make sure that your practice is sellable, that you can actually make something out of it? So thank you so much. I think it was very insightful. I'm sure people will find it very valuable. Of course, I will put all the links and to your business in the description box, but is there anything you want to share in terms of how people can get hold of you?
Yeah. So we've actually got a couple of blogs and articles that we've written just for sole props and guys starting out on their journey. So I'll share the link with you, and you can put it on your website so that people can read it if they want to. And then in terms of getting in touch with us, feel free to reach out. Like we always happy to help. We're in this business to grow businesses. As you mentioned, we are growth accounting services, and we're very passionate about helping business owners and practitioners run sustainable businesses, because I think from a South African context, we need more businesses to thrive. We need entrepreneurship to really rise to the sky, and we need to create employment opportunities. So reach out to us at any point. Happy to consult, happy to give advice and guidance. And if we work together, great. If not, we can definitely point people in the right direction.
Awesome. Wonderful. Thank you so much, George.
Fantastic. Tasneem, lovely chatting with you. We'll chat soon.
Thanks.
Cheers. Bye.